everyone. I'm Jade with Hive Nation. Hive Nation is an SAP marketplace built for consultants by consultants. We're here to help every independent SAP consultant like yourself to not only find your next project, but also help you to grow your income, your skills, and your network. On this show, we bring on the world's experts to discuss everything from how to implement the latest trends in SAP and technology into your everyday operations to helping you take your career in SAP to the next level. So check us out and join today at hivenation.com. Today, we have a very special guest. So I want to welcome everyone to another Hive Nation episode. Today, we'll discuss how to set up your retirement. As an independent consultant, you're no longer under the umbrella benefits of a large company, but you still have the opportunity to create your own 401k plan. A quick Google search will show you that there are many different types of plans, from a simple IRA to a solo 401k, but which one is right for you? We've brought on an expert who has been honing her knowledge in all facets of retirement plan administration, compliance, and design for almost 20 years. She's obtained several certifications, including her American Society of Pension Professional and Actuaries, qualified 401k administration designation, and tax-exempt and governmental plan consultant. Her dedication and enthusiasm for all things retirement helps her design the right plan for the right employer. Please welcome Tally Vaughn.
Hi, hi, hi. Thank you so much for having me today.
Yes, thank you, Tally, for being with us today. So, while you are a qualified expert in setting up retirement funds, as always, we do recommend speaking with your lawyer, accountant, and financial advisors. So, Tally, as mentioned, there are many different plans to choose from. If you're an SAP consultant who has just left a big consultant firm to become independent, which retirement plan would you choose that would provide the most tax advantages and benefits?
So, that is a layered question, right? Of course, everybody's situation is a little bit different. But usually, what I see when somebody's kind of branching out to from their, W-2 employee world, right? When they're working for a big employer and they kind of go on in that independent consultant world, usually we see them starting in the solo 401k world. Two reasons. Number one, it can help lower their taxable income from a personal standpoint, right? So think of those like 401k wages. You guys have all heard the words deferral 401k. That's kind of a personal deduction, right? You take that money off your paycheck and you stick it into the retirement, either on a pre-tax or after tax basis, depending. Additionally, that solo 401k world allows for employer deductible contributions. Now, the nice thing is both of those types of contributions in that solo 401k world are completely discretionary. So it allows with that flexibility, especially when you're starting off kind of new and young and, business being young, kind of regardless of your age, but it gives that kind of flexible element to it where you're not required to fund one way or another and you're not stuck inside of some of the other kinds of boxes. You mentioned a self-employment plan or a SEP. Those really you have one option, right? In the solo 401k world, you have many options. So usually that's where we see those consultants kind of starting out and seeing how it goes.
So, you talked a little bit about these tax advantages and benefits. Like, how do these really offset the funds needed to invest back into your company to start growing your business and even for basic living expenses while you're all on a fluctuating income?
Sure. So here's the thing. The nice thing about the solo 401k is it's discretionary. If you want to put in 19,500 and you're under 50, go for it. That lowers your taxable income. Let me give you a little bit of an example. Let's say for
Mhm.
sake of argument, you're bringing in 100K. Okay.
Mhm.
And I'm going to just use super round numbers for easy math. Let's say it's 100K. Well, the limit if you're under the age of 50 is 19.5. I'm going to round up to 20 just for easy math. Now your taxable income is about, not exactly, takes it from 100K that if you defer 19.5 on a pre-tax basis into the plan, now you're taxed on 80K. So although that is an out-of-pocket expense, where now your living expenses are one of those things that of course we are concerned with, of course needs to be a factor, but from a tax advantage perspective, having the opportunity to defer up to 19.5 if you're under 50, 26,000 if you're over 50, right? Having that advantage from a taxation standpoint is really nice to have in your pocket.
Mhm.
Okay. So, yes, it is one of those things that you kind of factor. You want to factor that into your budget, and you don't have to go for broke. You don't have to go 19.5 in your first year. You can build up. Call it 10 grand, call it 5 grand.
Hmm.
The thing about a 401k is if you don't use it, you lose it. There's no way to make up for lost time. So if you're an independent consultant and you're starting your business at 30 and what have you, if you don't start saving for retirement until you're 35, you've lost 5 years of those dollars being able to be deposited into the plan.
Right. And you said too with the solo 401k that this is very flexible and at your discretion. So, even if you set something up where you want to put away 5,000 or 10,000 or 20, let's say you're super ambitious, put 20, but then, you lose out on a project and your income fluctuates, you can change that right away. Is that right?
Exactly, hit the nail on the head. The other advantage is when your CPA is going through and doing your taxes at year end, right? 1231, we close everything out. Okay, we kind of know what your income is. If you need additional tax deductions, and your CPA is like, listen, you either pay $40,000 of government or you stick some money inside it for retirement plan and either reduce or eliminate that tax check you have to write, we can do that retroactively.
Okay.
So you don't have to commit to funding a employer contribution throughout the year like you would in your normal 401k dollars. And depending on the type of entity that we set up, right? So if you're an LLC, we have certain rules. If you're an S corp, we have certain rules. If your tax is an S corp, but you are an LLC, lots of different variations on how things can be set up. But there's different timing when it comes to those 401k deferrals as well in each of the different entity realms. So lots of flexibility and depending on kind of the entity that you do decide to set up using Hive Nation's resources.
Gotcha. And speaking of entities, California passed a law in 2020 mandating stricter rules when hiring 1099. So this was mainly in response to Uber using contracted drivers to avoid employment wages and benefits. And we've seen a growing trend in states protecting individuals. But that also means that 1099 hires are dissipating, which is one of the reasons here at Hive Nation, we advocate for independent consultants to form their own business entity. So, what should people be thinking about in terms of setting up their own benefits and tax advantages before forming their own company?
So number one, AB5, which is the California law that threw all of this kind of
Mhm.
hoopla in there, right, has totally thrown our whole world, regardless of the type of business, whether you're medical or your SAP or whatever, right? Everybody's been affected in one way or another. I will say, if you are planning on from a retirement plans perspective, setting up any kind of retirement for yourself that goes beyond that individual IRA, you have to be an established plan sponsor, meaning there has to be a legal entity established. So, setting up and starting with setting up a business, right? Getting and establishing your own entity is kind of number one. Now, the nice thing about the retirement plan world is you can be a sole proprietor
Mhm.
as an independent consultant, getting that 1099 paid from A person, B person, what have you, and be considered a legal entity. So there's lots of different options and lots of different ways to go. Definitely talk to your tax advisor on what is the best entity to establish for yourself. But as an independent contractor, and again, not legal tax advice, but deductions, tax credits, those kinds of things are very hard for an individual W 2 employee to get on their own. So if you can establish or you do have a legal business entity, oftentimes your CPA is really excited because there's more deduction opportunities
Right.
and more opportunities to save for retirement.
So, when you're setting up an entity like this, as let's say a solo LLC, or even considering bringing employees down the line, is there some flexibility with that, or are these some of the things that you have to think about before starting to form that entity?
So I think that's twofold. I think it's great in a perfect world. You kind of have a forecast of how many employees you're going to hire and when
Mhm.
that's going to happen and all this. But a lot of times in our independent contractors world, we really don't know.
Right.
We've just kind of terminated employment for maybe a big company and going, okay, I think I can do this on my own, but like who knows if this is going to take off or not,
Yeah.
right? So it's really hard to, oftentimes, it's really hard to predict whether or not there will be employees down the road, right?
Mhm.
In a perfect world, we know that ahead of time and we plan for it. Great. But establishing a relationship with the proper retirement plan providers, so like a third party administrator like myself that goes, okay, look, we get it's just you. We know that this is how it is for now, but let's make sure we put stop gaps in place,
Mhm.
put certain plan provisions in place for ongoing potential of growing your business and potentially changing your entity type and potentially changing and adding employees, right? So setting that up today with the plan of maybe even 5 years from now, and
Mhm.
of course, being in constant communication. We're a service provider, so we want to be there as kind of like you are, with your CPAs or anything else. But having us kind of be part of that conversation as you grow, if we can design the retirement plan kind of the forefront to go, listen, someday, maybe down the road at some point in my life, we'll have employees. That allows us to put some certain stop gaps and protections in place at the front end that doesn't bind us to certain requirements immediately upon hiring employees, if that makes sense.
Absolutely. So if you're starting off as solo LLC, but maybe one day you think you might want to change your entity, let's say become an S corp, bring on a few employees, like you said, business is booming and you're building. Even if that isn't in your plan right now, even if it's not even in your 5-year plan, but maybe it's in a 10-year plan, if you just see yourself going in that direction, even if it's 10 years out, to talk about it now. I love that because that's something we really don't. It's kind of like, "Okay, got my LLC. What's where's my next project? Let's go."
Right, right. And I'll tell you, not to jump
Yeah,
in,
absolutely.
but one of the biggest kind of hurdles that I see is when we get these independent contractors or, these sole LLCs kind of set up and they say, oh, we're going to set up a 401k. They go to their nearest provider, they get a document out of a drawer, they check a bunch of boxes, and then they hire somebody 4 years down the line. And they go, oh, no, 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 Jade's not eligible for the plan. And I go, well, per the document and the check boxes you wrote, she should have been eligible day one of being hired. So now here's all these compliance things, not only corrections we have to make, but now committed contributions that you're required to put in as a business owner that you weren't anticipating. So setting it up at the kind of the forefront is why I'm kind of being such a stickler for it, is like, even if we think maybe somewhere down the line or we don't think down the line, just preparing for that what if scenario is so important to do on the forefront.
Absolutely. And, speaking about, preparing on the forefront, should new independent contractors, should they pay themselves as an employee or take an owner draw?
So my disclaimer is I am not a CPA and I am not legally allowed to give tax advice, okay? So I'm going to throw that out there right now. But here's how the world of retirement works. There's what's called eligible income. So we have income that the IRS recognizes in each certain entity type. For example, if you're a sole proprietor and your tax is a sole proprietor, you're going to get a Schedule C. Your Schedule C is the income, the net Schedule C is the income that we can use for plan purposes. So oftentimes when we get the question of should I take a draw or should I take it as employee income, we're
Mhm,
usually talking about an S corp situation,
mhm.
right? Where they have a K1 and they have a W2.
Yep.
In that situation, the only compensation that I can consider for plan purposes is W2. Now, oftentimes strategies with CPAs is to take kind of the minimal W2 you have to and take a lot more and draw. So it's very
Okay.
important you work with your service provider and your CPA at the same time and make sure that jacking up that W 2 income does not throw them into a tax situation that makes that 401k or that solo or that income be prohibited from a tax advantage perspective. So it's kind of a dance, if I can be honest, where we all kind of want to work together to find that happy medium, and we always want to defer to our CPA when it comes to the taxable income we should be considering for plan purposes.
Gotcha, but that's interesting that they would kind of suggest a mix of both.
It's because certain taxes are applicable on the W 2 side that aren't
Mhm.
on that K1 side, right? So a lot of times we find those CPAs going, okay, let's take a lower W 2 and we'll take larger draws and then maybe even flip the compensation later, depending on, oh, now we need to pay into
Okay,
Social Security or whatever it is.
gotcha. So when talking about possibly hiring employees, let's say, your friend you're growing and you have too many projects and you bring your friend in to help you with another project in the SAP world. Would it be worth hiring employees that can work part-time at the company to take advantage of some of these benefits? Or, uh, are these advantages also available to you as a solo LLC? Just forward thinking, like if they are only thinking right now about a solo LLC, don't want to deal with employees ever, but would it be advantageous to actually think about doing that down the line, even, with the the growing enormity of what that means for you as a company?
So, loaded question, right? I think it depends on kind of where you are from a business perspective. If you have more business coming in than you can handle,
Mhm.
figuring out how you can either partner with somebody either in that as an employee or as a subcontractor or whatever the case is, you really want to look inside and see number one, there's payroll costs and workers' compensation and all of those kinds of things. Again, not a CPA, but all of those kinds of things that come into consideration, right? Now, when you are a single employer, and you have no employees, there are advantages in the retirement plan world where you don't have any out of pocket costs that you have to pay for another employee. So there's a lot of rules in the retirement plan world, right? We're covered by ERISA, so we've got laws and regulations we have to follow. The minute you add an employee to your docket is the minute you have to start making different kind of considerations. So for example, I can get $26,000 in my 401k if I'm over 50 by myself, no employer dollar is needed, right? If I don't have any employees, assuming I have the
Right.
compensation that can sustain it, obviously. I can get up to like $63,000 in a plan by myself, as long as there's no employees and my compensation can sustain it. Okay.
Right.
Now, the minute you add an employee is the minute that I have all me, my TPA world, I have all these really complicated compliance tests that come into the factor and that we have to now consider. So the minute we add an employee and that employee is allowed to participate in the plan is the minute that the employer is either going to shell money out of their pocket to be able to get to that 63,000 or is the minute that that employee or that employer is funding employer dollars to that employee so they can even get their 26,000 without being
Gotcha.
limited. So
So you have to be bringing in a bit of business.
exactly, exactly.
And so you said the maximum amount you can save away for a solo LLC was 63,000. Is that right?
It
Annually?
is. So and that's a combination.
Mhm.
That's so 58,000 if you're under the age of 50.
Okay.
63.5 I think is actually what it is if you're over the age of 50. There's what's called a catch-up limit, not to get super nerdy, but it's a combination of 401k contributions up to 26,500 and then anything over and above that to meet that 58 to 63.5 depending on your age bracket.
Okay, so you could still be on that solo 401k and still put in more. Oh, okay. Oh, interesting. So we talked about the solo 401k for people who are just kind of starting out in the independent world, starting to build their business. Would you say that that would be the same plan, or is there a better suited plan for more established independent SAP consultants, more people who are more in the middle of their career and looking to reinvest?
So I will say most situations, starting with a solo 401k, regardless if you're at the bottom or the top or in the middle of the career, is always going to be a good idea.
Okay.
Again, circumstances affect, but if you don't use it, you lose it, right? So if I don't have that 401k element to it, I'm missing out on tax deferred income of $26,000, right?
Mhm.
Potentially. Now, there is a more sophisticated kind of plan that we can put in place once your age, I would usually say right around the age of 40 is when we're starting to see what's called a cash balance or a defined benefit plan. So think of like a pension plan,
Okay.
starts becoming attractive. We need three things we need age, so 40 plus,
Okay.
wage, so six figures plus,
Mhm.
and longevity. And so we need that business to be established for a number of years before and show that kind of stability before we want to start looking at a pension plan. But looking at a pension plan, depending on your age, wage, and longevity with the business, will allow you to save exponential amounts more. So six figures in annual contributions that the employer funds, so
Mhm.
company contributions as a deductible contribution to the business, in addition to that 26 or 19.5 in the 401k, maybe a little bit of an employer contribution in that 401k side too, about usually it's about 6%.
Okay.
And then over and above in that cash balance or defined benefit plan realm where we can get kind of six figures. So oftentimes we can get more in contributions total than their compensation actually is. Where in the 401k only world, we're limited to 25% of eligible comp. So definitely as you get further down in your career, there are more robust benefits that we can throw in place for you.
Okay. And this isn't something that you need to think about at the beginning. This is something that you can just grow into.
It is because unlike the 401k and that kind of what I'm calling profit sharing or that
Mhm.
employer contribution world where it's completely discretionary, that cash balance defined benefit pension world is a commitment. So we really want to make sure that those profits are there and predictable each and every year so that if my team comes and says, Jade, you've got to put in $100,000 this year, you don't have sticker shock and you're not going, holy cow, where's this money coming from?
Right.
This is one of the things we want you to plan for and know ahead of time that, hey, this is coming down the pipe.
Okay. So this isn't, as what you had said, this isn't as flexible as a solo 401k where you lose a project, this would be a little bit more difficult to contribute to. Okay.
Right. Absolutely. Absolutely.
Gotcha. And so would this be the same, for more senior level consultants later in life? Would it be more in this defined benefits plan?
Yep,
Okay.
exactly. So usually when we're starting out, I'm just fresh into the independent consultant world, that's where you're going to see those 401k contributions being pretty attractive, right? Because now we're lowering their taxable income, which is always great from a business perspective, right?
Mhm.
Let's go middle of the road. Maybe we've been in business for 5-ish years. We're profit positive, right? Net profit positive, if that's
Hey,
a
you're in
term,
the black.
right? And now we need additional deductions from a business perspective. Let's layer on those employer contributions to get to that 58 or $63,000, right?
Mhm.
That's usually middle of the road. And in that middle of the road, that's when we start graduating to that pension, that committed contribution. When you're a senior, you've been doing this for a really long time. Your clients are your clients. You're not going project to project. You're more going from like guaranteed to guaranteed. That's when it's like, listen, we are looking at that pension for sure. That senior level is going for broke, right? We've got to get as many deductions as possible. They're expanding their network, they're expanding their clientele, and they know that it isn't contract to contract anymore. We've got well established contracts. We've got to get some big deductions and start saving for retirement.
Right, right, and it's almost there.
Yeah. Yeah, exactly.
So when you're at the senior level, so you're at this stage and you actually haven't put in any of these pension plans in place, is there anything that you can start doing now to ensure a retirement? So you're not working well into your later age?
That's exactly what the defined benefit plan and cash balance plans are built for, right?
Okay,
So I kind of mentioned before the 401k is like you don't use it, you lose it,
right.
right? I can't make up for lost time. Cash balance and defined benefit plan is truly made to make up for lost time.
Okay.
The older you are and closer to retirement, the larger the contributions can be for you to sock away. Right? There's commitments. It is not fluid. It is not super duper flexible. There's an element of flexibility to it, but it is one of those things that we want your profits to be predictable. We want you to be able to write a check for
Mhm.
$150,000. We want to make sure that we can grow that pot of gold for you in a shorter period of time, which is why I hate even putting an age on it, but it's why the age, wage, and longevity factors is the closer you are to retirement, the less time you have to save. So the bigger bang for your buck, typically those actuarial formulas are going to give you.
Gotcha. So it's good to know though that if you haven't had a 401k, all this time, that you're not completely out of luck, that there's something that you can still do. So you can go to, Florida and retire on a golf course or something.
Exactly, exactly.
So the current administration is working on these state mandated retirement programs. Can you go a little bit into that? I mean, does this mean there's potential for mandatory 401ks? How does this kind of affect the independent world?
So, a couple of things. Just about every state has implemented or begun drafting their retirement programs. I'm not going to call them plans, but their retirement programs. Each state is a little bit different. Some states, there's about 8 states, I think it is at this point, that have said, we're not doing anything. Okay, you guys are on your own. I'm sure you could probably guess what states there are, right? However, I think what you'll find is there is going to be some sort of national mandate, national rollout coming within the next, I'd say probably 5 to 10 years. Each state has started to kind of do their own thing, but I wouldn't be surprised if you saw this kind of kicking off on a national level where at least there was some kind of like bar to set at the beginning, right? Hey,
Mhm.
minimally, you have to do this. If you guys want to go above and beyond from a state level, go for it. But there's about, I think we're up to about 15 states that have put something in place. Some are optional, some are mandatory. I can speak to the California side. That's where I am. That's my bread and butter. So I can speak to that pretty heavily.
Okay.
What I'm seeing is 5 W 2 employees on the payroll is a mandatory retirement plan program. Okay. So they have to do something, either adopt their own 401k or adopt their own simple IRA or adopt what the California's program is called as Cal Savers, right? And go into the Cal Savers program. So I am seeing in most states there's a minimum employee count. Some are 10, some are 5, California's 5. I'm not at this point seeing any mandatory retirement for the single owner at this point. But
Okay.
kind of going back a few questions, it's one of those things that you want to consider
Mhm.
if employees are in your future, right?
Right.
Is listen, you might not want to offer a retirement program for your employees, but if you do decide to hire W 2 employees, it may very well be mandatory. So put that into consideration depending on the state you're in, because I know this is national, right? So depending on the state you are in and the employees in the state in which your employees are hired, whether or not that independent contractor route is a better way to go or hiring employees is a better way to go.
Right, and you said in California, it's a minimum of 5, some it's 10. If you're thinking of just bringing one person on to help with a couple more projects, have you seen any state mandatory requirements for that?
I haven't yet.
Mhm.
I don't know every state's mandates and rules, so I'll just kind of start there. I've got New York, New Jersey, California, Oregon, and Illinois pretty down pat. But the other ones, I haven't seen one employee. But
Okay.
again, if you hire one employee and your plan document is not set up to provide optimum protection, what ends up happening is either the dollar amounts that the employer gets to put in for themselves is significantly reduced. Or if the employer wants to continue to maximize their contributions, the employer needs to expect to also fund a employer contribution for their employees, regardless of whether they participate or not. So there's kind of give and take. Great, you're getting some work off your plate, right? By hiring an employee, but the downside is it potentially could limit you in your retirement plan depending on how it's designed.
Right. Yeah, and California is, a special beast in that way with the new ABC test for 1099s and, whether you're forming a solo LLC or an S corp. And from what I've been hearing legally, again, not legal advice, but we do chat a little bit about it in some of our Hive Nation articles and blogs, is really the need to look and feel and act like a business entity in order to be hired as an independent contractor. And that's huge because one of the things that go under that is hiring employees. So a lot of things to think about, when you're starting your own company, now that 1099s are moving out the window. So it's great to have you on the show and to talk about what we can do, because even though most companies are doing away with 1099s, it's actually really beneficial for the consultant to protect themselves and to save and to plan ahead for their retirement. And we all know that it's important to save for the future. The reality, unfortunately, is that a lot of independent consultants don't and end up working well into their later years. So do you have any, parting words for independent consultants who, especially ones that are new to the independent consultant world, who are enjoying the financial benefits of becoming independent but are a little hesitant to use their increased wages toward, honestly, right now, what may seem like an unseen future, you know?
I mean, what I would probably say is it's never too soon to start saving.
Mhm.
And realistically, I know it's really rad to go out and buy the boat and go to Vegas and
Lambo
party
and
it
all
up
that.
and enjoy. But if you don't use it, and I know I've said this 100 times now, but if you don't use it, you lose it. And I would hate for you to look back 10 years from now and go, man, that party was really rad, but had I taken $5,000 and stuck in an account with compounding interest and all of the fun rule of 72 or whatever financial advisors say, right? And you're losing out on a long chunk of time, which means you're gonna have to work longer. And part of being an independent consultant is you have a little bit more freedom because you're your own boss, right? So would it be really rad to be able to retire early or retire when you want instead of not being able to retire until you can, right?
Right. Because that could be the difference of 20 or 30 years.
It really can. It really can. Yeah,
So how do you wanna spend those those 20 or 30 years? You can be on a boat then.
exactly, exactly.
Wow, well, this was really, really great. So thank you so much for being on the show, Tally, and downloading us with all of your expertise. We really appreciate that.
Thank you so much for having me. I appreciate it.
And thank you, everyone, for listening. If you need help setting up your retirement plan, please reach out to one of us at community@hivenation.com. We may also actually set you up with Tally herself, and we can help build the perfect plan for your current needs. Also, our next show will be announced on both our site at hivenation.com and in our Hive Nation community app. So download the app today to stay up to date with the latest SAP trends, learn new practical solutions, and network with our SAP experts. Feel free to send us any questions or requests also to community@hivenation.com. Until next time, this is Jade with Hive Nation, a platform built for consultants by consultants.